Hello, good morning to all, and welcome to today's Daily Dose of Market Insights. Kelvin here again. Very good morning. Today will be Tuesday, the 16th of July, 2024. Very good morning. Before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into our daily dose of market insights, especially on the gist of it, which is the intraday technical outlook on the major dollar pair, the major stock indices, and two key commodities market, which is gold XAU/USD and West Texas crude oil. Let's have a recap of what has taken shape yesterday in terms of news flow, economic data release, and their respective impact on the various key cross asset classes, and as well as the medium term key intermarket dynamics that is playing out right now across the cross asset classes. So let us start with the key events and data flow first for yesterday. So for yesterday over here, what we could see over here was there's actually one key economic data release, which is actually in the Eurozone over here. So if you look at my screen, all right, so we do have the Eurozone industrial production for the month of May. So it came in still in negative territory, negative 2.9%, slightly above negative 3.1% year on year that was printed in the previous month of April. So that also indicating to us that the manufacturing activities in Eurozone still remains lackluster, but very unlikely that this time round ECB will start to do another interest rate cut in the month of for this Thursday. All right, because this is kind of lagging. It's for the month of May, so more or less the ECB has already taken into consideration on this lackluster manufacturing activities in Eurozone. So that actually explained to us their prior month interest rate cut ahead of the US Federal Reserve. So another we call it event that took shape yesterday was Fed Chair Powell public speech. All right, during an event. So during this event, he actually echoed that recent data rise, confidence of inflation on the path to 2%. So based on the latest three inflation reading, it add to somehow to confidence. That means, i.e., the US Federal Reserve tonality right now has started to or shift towards more on the dovish camp of the story, rather than having that initial thoughts of keeping interest rate at a higher level for a longer period of time. And this particular switch of a much more leaning towards the dovish side of the things has more or less been cemented the first interest rate cut to come in the September meeting based on the interest rate futures contract pricing as compiled by the CME Fed Watch 2. But after Powell's public speech yesterday, it actually interestingly increase of another potential interest rate cut to come in 2024 before 2024 ends. So what do I mean by this? So if you look at the CME Fed Watch 2, so this particular website shouldn't be foreign to you guys, because for those who are followed my daily dose of markets insight on a frequent basis, I've been using this particular CME Fed Watch 2 to gauge the market expectation on their pricing in terms of probability of whether the Fed will hike to cut, okay, based on the Fed funds interest rate futures contract. So if you look at over here, is that initially they're actually more or less baking two interest rate cuts before 2024 ends. So after US Fed Chair Powell public speech yesterday, no change in terms of the pendulum. That means, i.e., we're still looking for high odds of 92% chance for the first cut to come in the September meeting, which is on 18th of September, FOMC. Why do I say that? Currently, Fed funds rate is at 5.25% to 5.5%. Market is expecting Fed to stamp at 94% chance of no change. All right. then you shift down to your right, 25 basis point down at 5.5%, at 5% to 5.5% to 5.25%. That's a high odds of 92%. That means, i.e., market is expecting a Fed to actually move by 25 basis point down. That means a cut, an implied cut on the September meeting. And what's interesting over here is previously in the November meeting, there was a low odds of below 50% because that actually coincide with the US election. So, but over here, what the Fed is expecting, right, the market is pricing right now after Fed Chair Powell's speech, that's the market is expecting it to cut again in November this time round. That means another 25 basis point cut to bring it down to 4.75% to 5%, and thereafter another cut again in the December meeting, which is 18th of September, to bring it down to 4.5% to 4.75%, and the odds are quite high at 61%. So net overall, based on the current latest interest rate futures pricing as compiled by the CME Fed Watch 2, market participants now are looking for high chance of 3 interest rate cuts before 2024 ends, and incremental of 1 more interest rate cut, because in the previous week or since the start of this week on Monday, markets only looking at 2 interest rate cuts before 2024 ends. So net overall, what we could see over here is it has really impacted on the FX market. So the FX market has really priced in this Federal Reserve more dovish tilt right now, where we start to see the US dollar strength, I would say that the US dollar been transiting from strength to weakness. Why do I say that? If you look at the current US dollar index, technical, so the US dollar index has starts to plummet down since hitting its key medium-term resistance on 26th of June. All right, and it starts to break down over here, and overall it starts to actually close below both the 50-day, the 20-day, and even the 200-day moving average. All right, so weakness has already been priced in. So, and yesterday the US dollar managed to actually continues to stage a rebound. So we have 2 days of consecutive gain right at this range support area that is in place since March 2024, which is at 104 level. So that was this level here I've highlighted on last Friday daily dose, looking for a kind of a potential dollar strength intraday bounce to take shape. Why? Because we start to see a very steep dollar sell-off that has taken shape since 27th of June all the way down to 11th of July. So this more or less has come into the picture of that change in tonality from the Fed, from a higher interest rate for a longer period stance to a much more confidence stance that inflation trend has started to decelerate in US, as being expressed by Powell yesterday. And right now, what we could see here is that market participants now have started to price in the playbook, or revisiting the playbook of Trumponomics, or they call it the Trump trade. Why do I say that? Because of that unfortunate event that took shape over the weekend, where there was a attempted assassination attempt on Trump, and that actually stoked the middle ground sympathy votes towards Trump, based on betting markets right now. There's actually looking at high odds that Trump may gain the White House in November with a 60+% chance, compared to Biden, which is only less than 50% chance based on the live betting market. All right. So what we could see over here is that if Trump were to actually gain foothold in the US presidential election and manage to get re-elected to the White House, his Trumponomics policy will definitely focus on lower tax cuts. Later I'll touch more about that. Deregulation of some of the sectors, business sectors in the US, and also protectionism policy. That means, i.e., trade restriction or higher trade tariffs towards US trading partners that Trump may thinks has a view that is disadvantageous to the US economy. So that primarily will be targeting China, because based on his previous speeches, he's looking to have an additional 60% tariffs on China imports and an additional 10% tariffs on other trading partners that he viewed that has taking advantage of the US economy. So then overall, with trade protectionism coming into play, that could actually stoke the US dollar strength coming back into the picture as well. But definitely that is still early days, but something to look out for. All right. So now with that, that is the key news flow that has taken shape yesterday. Now let me touch on more on the data that is related to the intermarket dynamics. All right. So based on the intermarket dynamics, I'll be mentioning about this bull steepening of that 2-year Treasury yield against the 10-year Treasury yield. So what is this bull steepening about? So this bull steepening about is actually, okay, before I touch about the bull steepening part, let me have a quick look at the movement of the 10-year and the 2-year. All right, so this is the 10-year US Treasury yield. So we know that the 10-year US Treasury yield has managed to inch downward from a key medium-term resistance of 4.5%, and right now is looking to break below the low of 4.19%, which is the June low over here. Okay, looking to break below. But if you look at the 2-year Treasury yield over here, okay, very clearly is on the path of much more higher magnitude of a decline. That means the 2-year right now has already broken below the June low over here by a fair magnitude, and right now it's already hit a medium-term support level at 4.42%. So based on the current situation or the momentum of the US 2-year yield, is telling us that it's falling at a greater magnitude compared to the 10-year right over here. Okay, the 10-year hasn't fallen by a fair bit yet. So what it means over here right now over here is that we are now seeing a bull steepening of the US Treasury yield curve, with the 2-year falling faster than the 10-year, indicating to us that market participants are now looking for a much more dovish Fed to address the US economy softness that's being seen by various key leading economic indicator. Like I mentioned earlier in the previous daily dose, the University of Michigan Consumer Confidence that has fallen by 4 consecutive months for July. US ISM Services PMI for June has already hit a contractionary mode below 50. And also the latest non-farm payroll data has also started to turn soft. Why? Because the May and April figure has been revised downward, and most importantly, a very clear deceleration in the services component of the US inflation data on top of the core CPI data as well. So that actually see a shift in the US potential US Federal Reserve monetary policy, erring towards more towards the dovish side, and the 2-year US Treasury yield is much more sensitive to the change in the Federal Reserve policy, monetary policy. However, the 10-year is more linking towards US economic growth and long-term inflationary growth. So we know that the US inflationary trend has started to decelerate, so that actually causes the US Treasury yield to actually inch down to 4.5%, but it's not falling off the cliff yet. Why? Because market is still expecting the US economy not to slip into a recession or hard landing if the Fed starts to move fast to address this ongoing softness that has been seen in the key US economic indicator that I mentioned earlier. So with this US Treasury yield curve bull steepening, so this chart shouldn't be particularly be a surprise for those of you guys who followed my daily dose on a frequent basis. So I've been highlighting this chart since last week, looking out for a potential revival of the value factor. All right, so what is this value factor? So this value factor, what I did over here is just basically getting the S&P 500 value ETF. What is this ETF? This ETF is basically the modified S&P 500 reweight, where the value factor stocks component stock has a higher ranking. So this value factor ETF in the past, when the bull steepens, the bull steepening of the yield curve occurred during November 2020, that's actually the exposed pandemic era, to March 2021, we see the value factor actually outperform the normal market cap S&P 500. All right, and what's interesting over here is that the potential bull steepening has taken shape again, and this bull steepening odds will get higher if the yield curve managed to break above negative 0.8% key resistance level. And recently, in the last week or so, we start to see an uptick in the ratio of the S&P value ETF divided by the normal market cap S&P. All right, so what we could see over here is, I would say, is a healthy rotation potentially going forward on the heavily weighted momentum driven S&P ETF that is highly ranked by the momentum play, which is the mega cap stocks like Nvidia, Apple, Amazon, and Microsoft that has been leading the fort since the start of this year, and their momentum factor is being highly ranked in this S&P 500 momentum ETF. So this particular momentum ETF may start to do a bit of underperformance like what is seen during the November period of 2020 to the May 2021 period, where the bull steepening takes shape on the US Treasury yield curve. All right, so this is something not so foreign if those who actually follow my market insights of daily dose. And what's interesting over here is that this value factor ETF has starts to gain traction. It starts to actually see some form of outperformance on a very intraday basis on the Nasdaq 100 and the Russell 2000 as well. So for the past 2 to 3 sessions over here, the Dow Jones and the Russell 2000 has starts to outperform against the heavily weighted mega cap S&P 500 and the Nasdaq 100. The Dow Jones yesterday gained 0.5%, managed to outperform the S&P 500 at 0.28%, and as well as the Nasdaq 100 at 0.27% yesterday. And the top outperformer was the Russell 2000, up 1.8%. All right, so this Russell 2000 primarily has also been driven by this it's a double positive impact. Potential bull steepening of the yield curve. On top of that, we start to see the revisiting of the Trumponomics playbook. All right, why? Because Trump policy itself during his time in the White House during 2016 to 2020, he tends to advocate make America great again policy. That means we're talking about fiscal policy that is favoring towards American businesses that has a high revenue, we call it flow, that is dependent on the US economy rather than international. All right, over here. So that actually explains why the Russell 2000 managed to actually outperform the Nasdaq 100. All right, so with that, right, if you were to actually one more evidence, you can actually just Google the Dow Jones Industrial Average components by just looking at the S&P Dow Jones Indices website. So what I did over here, this is the latest fact sheet, right? So if you look at the sector breakdown of the Dow Jones Industrial Average, the financials form 23%. All right, almost on par with the information technology, which is slightly lower at 90%. But if you combine the healthcare and consumer discretionary, both are actually value factor, means financial, healthcare, and consumer discretionary are considered as value stocks that has a higher value ranking. If you add them up together, it comprises close to about 40% over the information technology sector. But if you look at the S&P 500, is heavily skewed towards the information technology, which is at 32%, whilst the financials is only, and healthcare both are actually only at 12% and 11%, and the consumer discretionary is at 10%. All right, so that actually explained to us the performance. If the value factor, put it away, the catalyst will come from the bull steepening of the US Treasury yield curve. So if the US Treasury yield curve going to inch up higher and break above this level of negative 0. Where was it? Where was I? Give me back to the chart. Yeah, and it starts to break above negative 0.08% over here. Okay, break out above, the bull steepening scenario will gain much more further traction, and the value factor will start to outperform the normal S&P 500, which will potentially see further outperformance of the Dow Jones Industrial Average. All right, as being expressed by their much more heavily weighted components component sector weightage in the financials, healthcare, and consumer discretionary, and some form also the industrial as well, which is at 14%. That's quite high. Yeah. So on the Russell 2000, if you look at the sector breakdown over here, okay, the industrial, healthcare, and financial took the top 3 weightage. All right. So if you look at the industrial over here, is at 15% each, and as well as the financial both at 18%, 15%, 50%, and the technology is only 14%, much more lower weightage as compared to its sector heavily sector weightage of 32% in the S&P 500. So for sure, if the US Treasury yield curve shape that bull steepening much further and gaining traction by the breakout above the negative 0.08% key resistance level, the Russell 2000 will also benefit as well. All right. And if you look at from a technical perspective by graphical representation and momentum, let me share with the next chart again. Okay. Okay, so this chart, so this chart is my first time showing in my daily dose, something that I monitor closely as well. So very interesting over here is that this particular line, the green line, the dark blue line and the orange line is the ratio of the Dow Jones Industrial Average divided by the Nasdaq 100. And the orange line is the ratio between the Russell 2000 divided by the Nasdaq 100. And what I did over here is that I form a derivative of this ratio by plotting in the 10-week rolling performance of the momentum. That means it's basically the rate of change. And also this orange historical bar is a derivative of the ratio, which is the rate of change. All right. So if you look at the rate of change over here, is shaping a bullish divergence for both the ratio of, that means the rate of change of the Dow Jones ratio versus the Nasdaq 100, and the rate of change of the Russell ratio versus the Nasdaq 100 is shaping that very clear bullish divergence. And this bullish divergence came in line with the unfolding US Treasury yield curve bullish steepening scenario. All right, so this purple line, okay, so this purple line here is the same purple line that I flashed to you earlier on. And interestingly over here is that this reason underperformance, because it's still underperforming. This on terms of the ratio, okay, that's the raw price action, has kickstarted since the start of the Nasdaq 100 most recent major uptrend phase that started in early October 2022. All right, but however, if this bull steepening starts to take shape, very similar to the episode that was in November 2020 to March 2021, we start to see the ratio of the Dow Jones and the Russell 2000 has starts to outperform the Nasdaq 100 during this period of time. All right, right before the start of the most recent major uptrend of the Nasdaq 100 that has taken shape in October 2020. So given that if this is the leading catalyst, if it starts to do that bullish steepening much further, a breakout above negative 0.08%, we will potentially see this similar outperformance that could start to take shape between the Nasdaq 100, the Dow Jones, i.e. outperformance of the Dow Jones Industrial Average over the Nasdaq 100, and the outperformance of the Russell 2000 over the Nasdaq 100. All right, so potentially telling us that in the next couple of weeks, the Nasdaq 100 in terms of percentage gain and the Russell 2000 in terms of potential percentage gains could be much more higher than the Nasdaq 100 because of the rotation into these two laggards, supported by the bull steepening of the US Treasury yield. And in terms of momentum factor, the ratio has really started to shape that bullish divergence condition as being expressed by their rolling 10-week rolling rate of change indicator. All right, so that I hope that I make myself very clear right now what's going on underneath the US stock market from a intermarket dynamics. All right, so that's the key intermarket dynamics movement that hasn't really starts to being seen yet by the market or fully priced in the market at this point in time that I'd like to share with you all. All right, so with that, now let us now take a quick look at the maybe shifting our focus now to the short-term intraday dynamics on the various key cross asset classes. Okay, so the short-term dynamics right now, let me very quickly expand my screen first so that you guys could actually see the key levels much more clearer. Let us start with the intraday technical outlook on the FX market first over here. So starting with the euro dollar. So like I mentioned yesterday, the euro dollar, we do have a short-term intraday bearish bias because of the overbought condition of the euro dollar due to the very strong push up that was seen last week. So yesterday, the euro dollar indeed retested the pivotal resistance level at 1.09, 1.025, can't make any headway above it, and the hourly RSI continued to shape a lower low over here. So for sure, this is indeed a pivotal resistance to watch out for. So no change on the euro dollar, still keeping that short-term intraday bearish bias for the potential short-term intraday minor corrective setback scenario to take shape within its short-term and medium-term uptrend phase that is still intact. Why? Because the price action continues to trade within this minor ascending channel that I draw from the low of 26th of June and above the 50-day and the 20-day moving average as well. So it's more like a setback corrective move to cover this gap over here, as you can see in my screen. All right, after that strong rally that was seen in the early part of last week to middle part to the middle part of last week as well. So first support level that you got to break down for that potential minor bearish bias scenario, intraday bearish scenario to gain traction is the 1.087 level. A breakdown below 1.087 level exposes 1.0840 next. A break below it potentially could revisit 1.0805. However, if you start to see an hourly close and a breakout above this 1.0925 short-term pivotal resistance, then this short-term intraday bearish bias will be invalidated for the euro dollar to see the continuation of an impulsive up move sequence to expose the next near-term resistance at 1.0945 followed by 1.0960. Right, that's for the euro dollar. Moving on, next will be the sterling or the cable. All right, so the sterling and the cable against the US dollar also managed to actually test that short-term pivotal resistance that we highlighted yesterday and shape a minor pullback. All right, so still no change. For sure, this 1.30, 1.3010 is indeed a key short-term pivotal resistance level. And we will maintain our short-term intraday bearish bias for that potential minor corrective setback scenario to play out to cover this gap within towards this minor ascending channel that the price is still trading with, the price action of the sterling dollar that is still trading within it that I drew from the low of 2nd of July. Near-term resistance level, near-term support level to watch for this potential minor corrective pullback or setback scenario to play out will be at 1.2930 followed by 1/1.29 figure level. Only a breakdown below 1.29 figure level will trigger a potential a much more deeper minor corrective pullback scenario to actually expose the next near-term support level at 1.2845. However, a breakout with an hourly close above 130.10 short-term pivotal resistance will invalidate today's intraday bearish bias on the sterling dollar to see the continuation of the impulsive upmove sequence to expose the next near-term resistance at 1.3040/1.3065. Above it sees 1.31 figure, 1.3155 next. Right, now moving on to the dollar major against the Asia Pacific currency over here, starting with the Australia dollar. So the Australia dollar yesterday, we do have a short-term intraday bearish bias, keeping our bias since last Friday. Price action indeed came down below 68 figure short-term pivotal resistance level that we have and broke below the 6745 first support level. All right, so with that, price action right now is really at the overbought oversold zone, we could see, but upon hitting the oversold zone, there is no form of a bearish exhaustion because there's no bullish divergence that's being formed yet at this point in time. So net overall downside momentum still remains skewed towards the bearish side of the story over here. Okay, let me expand my screen. So given that the price action already hit the first support level of 67.50, we will actually now tighten our key short-term pivotal resistance level right now. All right, so we have a tighter key short-term pivotal resistance over here, which is taking into account of yesterday's minor swing high at 67.85. All right, so let me push it down. Oops, let me do a bit of adjustment. Okay, 67.85. So this will be no longer the short-term pivotal resistance for today. Okay, good. Okay, so as long as 67.85 short-term pivotal resistance hold in any chance of a minor bounce, because why there could be a minor bounce because of the RSI now taking up from the oversold level. So the first minor bounce resistance to watch out for sure will be this level over here, which this inverted minor inverted V shape at 67.63, where it actually triggered that intraday bearish Marabusu candle at the start of today's Asia session, which is at 6763. Okay, 6763 over here. And as long as this bound didn't surpass the Titan key short-term pivotal resistance of 6785, give a bit of breathing space, potentially the Aussie dollar could still maintain its potential intraday bearish bias to continue this minor counter trend setback scenario on the downside. Potentially next near-term support level to watch will be at 67.20, followed by 67 figure level, which also correspond to the rising 20-day moving average. However, if you start to see a breakout above 67.85, then this short-term intraday bearish bias will be invalidated to see a revisit of the 68 figure level. Above it exposes the next near-term resistance of 68.25/68.40. Okay, that's for the Aussie dollar. Now moving on, next will be the dollar yen over here. So the dollar yen indeed bounced off from this key short-term pivotal support level. Why is it key? Because it managed to test one time, two times, three times yesterday, and indeed after yesterday it tests and it formed a bullish hammer. And also this also confluence with the 50-day moving average as well. So like I mentioned earlier on, it's actually due for a potential counter trend rebound rally after that steep sell-off that took shape on Thursday, on the onset of the softer US inflationary trend. This particular sell-off over here is still debatable because some of the market watchers did mention that it could be also be triggered by Bank of Japan MOF intervention. Okay, but nevertheless, we're still potentially looking for this counter trend rebound to play out, which is indeed has already started to play out after that strong bounce, intraday bounce yesterday, right at the 57.45 level. So resistance level to watch for this bounce to take shape will be still no change at 59.45, followed by 59.90/160.30. So what are these levels? So this level is for sure is a graphical level over here. Okay, graphical resistance, former minor range support from 27th of June to 9th of July now turns into a pullback resistance, and as well as the 20-day moving average acting as a resistance as well. And if you do that Fibo retracement of the entire sell-off, taking into account of yesterday's intraday low, that also corresponds to the golden ratio of 61.8% as well. Okay, making it a very clear form of magnetic resistance zone to watch out for. So as long as 15745 short-term pivotal support holds, we will still maintain that short-term intraday bullish bias. Okay, so slightly higher, there will be a first support level here to watch out for. Okay, at of 15820 mark. All right, so as long as any pullback again didn't surpass below 15745, still maintain that short-term intraday bullish bias, pardon me, maintain that short-term intraday bullish bias for this potential minor counter trend rebound to play out. Resistance level no change, 15945, 15990/160.30. Only an hourly close below 15745 will invalidate today's intraday bullish bias to see the continuation of the impulsive now down move of the dollar yen to expose the next near term support in first step at 15665 / followed by six-figure level, which is the minor swing low of 12th of June. Okay, now with that actually sum up the short-term intraday technical outlook on the major FX dollar pair. So now let us move ahead with the major key indices, the stock indices. All right, pardon me, starting with the Asia indices first. Hong Kong 33. So Hong Kong 33, yesterday we do expect that slide to take shape. So that slide actually happened. And right now it's actually testing the short-term pivotal support that we mentioned, 17,790 level. All right. So if we do the Fibo retracement over here, okay, taking into account of this last push up, last steep prior steep rally, it actually hovered at the 61.8% Fibo retracement as well. And also right now, the hourly RSI has really dipped down into a oversold level. And this oversold level, very interestingly, let me expand it. Okay, over here. Okay, it's coming close to a level where previous price action managed to stage a bounce, all right, over here on 9th of June, and as well as on the 28th of June over here. There's some form of bounce taking shape after hitting close to this oversold level of 23.55 based on its relationship of this oversold level and its prior price action. And with that over here, we start to see some form of bullish reversal candlestick that's being formed on the hourly RSI as well. Prior to that, prior to this hour that we are speaking, is start to form a bullish inverted hammer, and right now it's also trying to form a bullish hammer formation on the hourly candlestick of the Hong Kong 33. So with that, right, I'll have a bit of excess over here, slightly below. So this congestion area here, so I will slash it. Okay, 17,790 slash 660. All right, 660. A bit of excess below it. Okay, so given the fact that it starts to form bullish elements, short-term bullish elements, we will still maintain that short-term intraday bullish bias since that it really hit the 7790 short-term pivotal support level. Then I will slash it 660. First resistance to watch over here is the 20-day moving average, which is surpassed below yesterday, and this congestion area over here, 17,900 slash 17,970, which is also this former pullback resistance now turns into a resistance again level as well. There's a reintegration below it. So in order to say that this is a noise, some kind of bearish noise, it got to actually very quickly break above 17,970. All right, 17,970. So a breakout above 17,970 will increase the odds of this short-term intraday bullish bias to revisit or retest the next near-term resistance at 18,225. All right, but however, if price action continues to break down and below 17,660, then this bullish intraday recovery scenario will be invalidated to see a retest of last Tuesday and Wednesday swing low area at 17,430 slash 17,360 next. Okay, that's for the Hong Kong 33. And today, the Japan stock cash market has really resumed back its trading from yesterday break of the day. Yesterday was a public holiday in Japan. So taking a look at the Japan 225 and the Nikkei 225 short-term intraday technical outlook continues to remain in a bullish dynamic. So last Friday, we do have a short-term pivotal support level at 41,090. Price action managed to bounce off from this support level, which is also the former minor ascending channel resistance now turns into a pullback support level, and the hourly RSI continues to shape a series of higher high, and after the bullish divergence has taken shape and now inching back above the 50 level mark, indicating to us some form of short-term bullish momentum has started to creep back into the Japan 225, i.e. Nikkei 225 stock index. So with that, no change, still maintain that bullish bias on the short-term intraday basis on the Japan 225. Still using 4190 as my short-term pivotal resistance. Next near-term resistance level to watch will be at 4182, 820 followed by 42140. Only a breakdown of the hourly close below 4190, 41090 will invalidate today's intraday bullish bias to see the Japan 225 floating downwards to expose the next near-term support level at 40,800. A breakdown below it, revisit 40,250, which is also confluence with the rising 20-day moving average as well. Now, moving on with the European stock indices, the German 30 or the German DAX. So the German DAX continued to float down as expected, hitting our first support level at 18,630, now turns into a pullback support level. So it's going to trade in a very complex expanding wedge configuration since its low of 14th of June, by this depicting by this purple line over here. So yesterday the bearish reaction was right off the upper limit of that expanding wedge configuration, so indicating to us that potentially it could still be remains inside this expanding wedge. If it's indeed an expanding wedge, there's could be high odds that it may start to float down within at least the lower half of this expanding wedge. It still has much more room to go. All right, so with that, I will have a tighten key short-term pivotal resistance for today, which was yesterday minor swing low, where this level break and it starts to give shape that various hourly of bearish downside movement that's taken shape. So this is indeed a trigger level, now turns into a short-term pivotal resistance for today. And if I were to do that Fibo retracement of yesterday's slide, it actually corresponds to the golden ratio as well, 61.8% Fibo retracement. So with that, using a tighten key short-term pivotal resistance at 18,710, we will actually maintain that short-term intraday bearish bias within this complex expanding wedge range configuration that is still taking hold of shape on the German 30/German DAX index. Next support zone to watch out for will be 18,500/18,450, which correspond to the 50-day moving average, and as well as the minor swing low of 11 July. A breakdown below 18,450 may risk revisiting the minor swing low of 10th of July at 18,235. That is, I think, as a next near-term support, right, at 18,235. Only an hourly close above 18,710, that means a breakout with an hourly close above 18,710, will invalidate today's intraday bearish bias to see it squeezing up towards the upper limit of the expanding wedge again at 18,400 level. All right, 18,840 level. Above it exposes 18,935/19,010 next near-term resistance zone to watch out for. Right, so that's for the German 30. Moving on will be the major US stock indices, starting with the US Wall Street 30, i.e. the Dow Jones Industrial Average. So the Dow Jones Industrial Average yesterday hit our resistance at 40,340/40,440. All right, then thereafter it traded sideways over here. So net overall, since it's really at the upper limit of this minor ascending channel that I drew from the low of 14th of June, potentially there could be some form of minor pullback taking shape. So as long as this minor pullback, first minor pullback support level to watch will be at 40,040. Maximum will be this tighten short-term pivotal resistance support level that I have at 39,900/39,800. So as long as this tighten key short-term pivotal support holds for any form of pullback that you could see during the intraday basis, we will still maintain that short-term intraday bullish bias on the US Wall Street 30. Next resistance level to watch after 40,440 will be at this 40,660 next. Right. However, if we start to see an hourly close below 39,800, then this minor pullback could actually extend much further towards the downside to expose the next near-term support at 39,620 and 39,325, which is the lower limit of this minor ascending channel from the 14th of June and corresponding to the rising 20-day moving average as well. Okay, so that's for the US Wall Street 30. Moving on will be the short-term intraday technical outlook on the Nasdaq 100. So on the Nasdaq 100, no change, very gentle form of uptrend movement since the retest of the minor ascending channel that I drew from the low of 31st of May. So still no change, still using the 20,060 as my short-term pivotal support level, which is also correspond to the rising 20-day moving average. Still maintain that short-term intraday bullish bias on the Nasdaq 100. First resistance to watch will be at the current all-time high area, 20,620/20,710. Above it exposes 20,900 next. All right. However, if you still start to see an hourly close below, a breakdown of hourly close below the 20,060 level, short-term pivotal resistance level, then this intraday bullish bias will be invalidated to kickstart another minor corrective decline scenario within its short to medium term uptrend phase to expose the next near term support zone at 19,660/19,520, which is the minor swing low of 25th of June, and as well as the lower limit of this medium term ascending trend line that I would say that is the medium term ascending trend line that is also acting as a support at 19,520, in place since the low of 19th of April this year. Okay, so that sum up the short-term intraday technical outlook across the major stock indices. Now let us move to the major commodities that we cover, starting with gold XAU/USD. So gold XAU/USD continues to move up higher and hit the first resistance that we highlighted, 2,435, before shipping that pullback. All right, hourly RSI still showing no signs of a bearish exhaustion, still continues to remain in a bullish dynamic, by shipping this higher low right above the 50 level mark. So indicating to us that bullish momentum at this juncture still remains intact on the intraday basis for gold XAU/USD. So first pullback to watch out for, that it managed to survive during the Asia session at 2,417. So with that, I will have a tightened short-term pivotal support that we have for today, taking into account of yesterday's low at 2,402. So as long as this minor pullback didn't break below 2,402, we'll still maintain that short-term intraday bullish bias on gold XAU/USD. A breakout above 2,435 will revisit the current all-time high area that was printed in 30th of May at 2,450. Above it sees the next resistance coming in at 2,473, which is a Fibo extension of 1.236, taken from the low of 26th of June. However, if we start to see an hourly close or hourly close and hourly breakdown below 2,402, then this short-term intraday bullish bias will be negated to start to shape another form of a much more deeper minor corrective pullback to retest the minor swing low area again of 2,391/2,383, which is the minor swing low, former swing high area of 5th of July and 10th of July, and as well correspond to this minor ascending trend channel support that I drew from the low of 26th of June. A breakdown below 2,383 will further trigger a much more steeper minor corrective pullback to expose the next support level at 2,368 and even potentially 2,350, which also confluence with the rising 50-day and the 20-day moving average. Overall, net, even though it starts to break down below 2,402, the short to medium term uptrend goal phase still remains intact. All right, so now moving on, lastly will be the oil market over here. So going forward, let me open up the chart of oil. Okay, where is it? Okay, I may have closed it accidentally. Okay, let me reopen again. Okay, I may have closed it accidentally. My apologies. Okay, so WTI crude oil, West Texas oil. So West Texas oil yesterday, we flipped to a short-term intraday bearish bias, given that it has really broken down below this former minor ascending trend line that I drew from 10th of July at this 20-day moving average. So price action going to inch down much lower at a slower magnitude. So still no change. 83 short-term 83 figure level, short-term pivotal resistance. Maintain that short-term intraday bearish bias. First support level to watch 81.30. A breakdown below it exposes 80.56 level. However, only an hourly close above 83 figure level will invalidate today's intraday bearish bias to see a messy corrective push up to retest the former minor swing, the minor swing high of 2nd of July and 5th of July, acting as a resistance at 84.40. Above it sees 85.05. All right, so that sum up today's intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the calendar. What are the key data point, economic data to watch out for? So over at the European session, we do have a key leading economic data that is coming out from the Eurozone at 5 p.m. Singapore time. We have the Eurozone and the Germany ZEW Zoo Economic Sentiment Index for the month of July. That's out at 5 p.m. Singapore time. Then thereafter, for those who are actually focusing on the Canada FX, the Canada pair in terms of the FX market, we have the Canada inflation data for the month of June coming up at 8:30 p.m. Singapore time. Then most importantly for US today, we have the retail sales figure coming out at 8:30 p.m. Singapore time. Given that we have a slight a weakening of the services PMI data and University of Michigan lackluster consumer confidence that was released on last Friday, it could actually have a negative spillover impact on the sales figure as well. So something to look out for at 8:30 p.m. Singapore time. Then thereafter, we do have some housing market index that's coming out, NAHB housing market index that's coming out at 10 p.m. Singapore time for US. Okay, then thereafter, we do have a Federal Reserve official speaking at 2:45 a.m. Singapore time. Fed Kugler is speaking, and for those who are focusing on the Kiwi, the dollar Kiwi, the Kiwi dollar, I would say, or some of the Kiwi cross pair, we have the inflation data, the quarterly inflation data for Q2 out at 6:45 a.m. Singapore time for New Zealand. All right. So with that, that sum up today's daily dose of market insights. So Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.